Thank you for joining me and Austin Fitch of Horizon Investments. It is always a pleasure to speak with him. We are going to kick off a summer series where we're speaking with what I would call our primary investment firms that you may know, have seen before as part of the conversations with Tranquilli Financial Advisor. It is always good to have Austin Fitch of Horizon Investments join us. Austin is a chartered financial analyst. He is the managing director of consulting solutions as part of the investment team at Horizon Investments. Austin, as always, thank you for the time. We are going to take about 20 minutes or so to have a good conversation. Stay focused. As you can see from today's attire, it is the summer. It is about 80 degrees out. So I'm a little more casual than Austin today. Austin, thanks again for joining us. Welcome back.
Absolutely. Thanks for having me, Lou. Looking forward to jumping into the conversation today.
That's a good conversation because we do have plenty to cover. It has been an interesting start to 2023. Headline news, everyone would in passing glance think that all is wonderful. Markets are up. It's easy peasy. We're back to the good old days. But I would say that the underlying conversation is quite different than that. And we've had several of them this year already on behalf of Tranquilli Financial Advisor clients. So I'm just going to jump right into it, if I can, Austin. Ask you to give us a brief review of the first full 6 months of 2023. How did we get to where we are right now? What's driven, say, certain indexes up, but others not up quite as much?
Yeah, absolutely. And Lou, to your point, if you went to sleep on December 31st and you woke up on, let's say, June 30th, you would have looked at the market broadly and thought it was a really strong first half of the year, and probably, everything was rainbows and butterflies. I think we can probably all agree that there's been a lot more volatility in the underlying than just that on the face of it. To your point, headlines can kind of blur out some of the detail there. What has driven markets for the last 6 months has almost entirely been some of those mega cap growth names. Think Metas, think Amazon, think Google. If you actually look at the breakdown of those, I think it's the top 7 names in the S&P 500. They've accounted for almost, I think, in some cases, almost 80% of the total return of what you're seeing in the index more broadly. So we've joked internally that it really should be the S&P 7 and then the S&P 493, because the rest of the S&P 500 really has done almost nothing year to date. So it's been a very different experience if you haven't been invested in those 7 names. So if you haven't had that growth tilt towards some of these, again, kind of mega cap tech names, it's been a very different experience. To your point, some dividend paying stocks or dividend paying indices year to date, in some cases, are actually negative. Very different than the S&P 500, which is up, 13, 14%, depending on, where you sit on the given day. So it's been a really kind of bifurcated year in terms of what's driven returns. And a lot of that has come from some of the AI conversation, some of the conversation around what tech looks like going into the remainder of this year and even into next year. But yeah, it's been a really interesting year, albeit or in spite of kind of the strength that you see from the headline numbers.
All right. And certainly someone could look at you, Austin, and say, well, so what? If it's only 7 stocks out of 4 or 500 that are up, why do I care? That's what the index is for. Well, I one of the more recent or the most recent short video that I sent out to clients, I talked about volatility on the upside, and that is a perfect example of volatility on the upside. Those 7, they leave us behind. All of a sudden, things collapse, and it's very risky. So that's really what the volatility in the upside is, and you've just described by these 7 shares. So let's talk about what could propel not the S&P 500, because both you and I agree, and we've shared it with clients in the past. It's really not a great, in our opinion, index to look at all. I prefer the Russell 2000 small company stocks. Even the S&P 500 or S&P 1500 would be a better example. And I'll give you one more. The equal weighted S&P 500 would be better indexes for all of us to use. But Standard & Poor's has done a great job of advertising. So the S&P 500 is the one talked about the most, and we're doing it right here in the kickoff. So what would propel markets overall higher in your view as part of the investment thinking at Horizon? What would turn this wall of worry that the market climbs, and for everyone who hasn't heard that before, the market climbs a wall of worry, and we're right in the midst of it as advisors. What would propel it higher? Or what would just stabilize it? Let's not even worry about it being higher. What would give us some kind of stability under more of the market in the second half of the year?
No, and I think that's a great way to think about it, Lou. I think this idea of uncertainty has really been what we've been dealing with for, at this point, call it a year, if not 18 months. But especially over the last 6 months. And to your point, there's been volatility. We've seen volatility higher in the first 6 months, but there's still been volatility. And I think the question that you've posed is an important one. What do we need to see in the next 6 months or next, back half of the year that really starts to eliminate some of that uncertainty, right? Because a longer term, that will allow for markets to maybe go higher, but also it'll create a little bit more certainty from an investment and create confidence from an investor perspective. And really what drives that is a couple different things. One is this fact that the inflation conversation needs to continue to go lower. I think we've seen a lot of the inflation data really on kind of a one-way path, and it's gone significantly lower than where it was even a year ago, but it needs to continue on that path. We need to get back into that 2 to 3% range from an inflationary perspective. Again, we've talked about this in the past. Inflation absolutely is a backward-looking indicator, but it also has some forward-looking implications in terms of consumer confidence, investor confidence. So you're going to need to see that continue to move in that direction. That then dovetails into the next piece of it is the Federal Reserve. And we've seen the Fed be very active in terms of hiking interest rates over the last year plus at this point, in terms of talking about it and then actually doing it. So you've seen that play out, pretty precipitously. We would need to see, as that inflation piece comes down, hopefully you'll start to see the Fed take kind of their foot off the gas pedal, which hopefully helps us as an economy, as a market, longer term as well. Now, I think what's interesting is this idea of, does the Fed start to cut rates again? I think that's something that we don't actually really need. In some cases, that may signal some weakness in the economy if they feel like they have to cut rates. But what you would expect or would hope to see is at least a pause in terms of the Fed from hiking rates. Now, we'll probably see a Fed hike in July at their next meeting. The odds are looking like you may get a Fed rate hike, but the hope is that maybe you get 25 basis points in July, and maybe that gives them enough to where they feel like they can stop or pause from any future rate hikes. And I think that, coupled with kind of this disinflationary momentum that we've seen, I think those are two big things. The only other thing, Lou, that I'd mentioned, and we've talked about this in the past too, is just the strength of the consumer. You've seen balance sheets, you've seen income statements, you've seen the consumer that's an employed consumer. So you see a consumer that's actually in a pretty good spot, all things considered. Now, they may not feel that way if they're reading the headlines or dealing with some of the volatility that has persisted for a little while now. But if you look at kind of financial stability, the consumer is actually in a pretty good spot, all things considered. So as long as that continues, you see inflation coming down, maybe the Fed pauses, you're in a pretty good spot to start to rein in some of that uncertainty. And again, give the market a chance to continue to go higher, but to do so maybe in a less volatile manner.
All right. We certainly cannot give any specific investing advice right now. That would be against SEC rules and non-compliant. However, I'll say the sense is you're a little more confident than maybe you were to start the year because the Fed has already caused a pause here. And just to summarize, your camera or your recording was breaking up just a little bit. You're looking for the Fed to potentially pause for a little longer after another rate hike. We've just read recently, we're in early July here. We've just read recently that a number of the members of the Federal Reserve Board were considering hiking interest rates, but instead they took a pause. So with that included, and the consumer staying in a good position to continue to consume, as we talked about, you are correct in the past, the Fed isn't fighting some nebulous enemy. They're fighting the U.S. consumer. Okay, they want us to cut it out, kind of thing, and we won't. So if they get a little bit of a calm down with that, and interest rates are increased slightly, then we are in an environment where the stock market has an opportunity to stabilize, continue upward. So I think that's a good summary of all of it. One thing left out, which we don't want to get into the politics of it all, but war in Europe, Ukraine.
Yep.
Obviously, there are some changes there. That any positive news on that, I think, would also be an impetus for the market to propel forward.
Completely agree. Yeah, if you get anything kind of positive coming out of the Russia-Ukraine situation, I think that's only a benefit globally for equities.
For mankind, okay, and let's have it. All right, let's have it. So, I do want to bring this up. I think you got a kick out of it when I emailed you. It was another term that clients will have to get used to hearing me talk about, or those who are watching the video who aren't clients will get used to hindsight confidence. I'm seeing a lot of hindsight confidence. Mm-hmm. We are in an environment where on 19 months of a negative market, okay, the fact that the stock market or the index that we've mentioned already is up for the year, it is not up over the course of the last 19 months. It is still down, and it's down fairly significantly in my valuation. So with that, I'm getting a lot of email from, we'll say, others that say, oh yeah, look at it go. It's up. And I'm not talking about clients or other people. I'm talking about advisors or commentary that look at it go. You just stick with it. Well, that is, so when I coached baseball, I used to love when I would, and not really love this, but you would hear the opponent, their coaches, after a kid would make an error, say, don't do that. And we would get a laugh at it because we called it after coaching. Mm-hmm. Of course the kid won't want to do that. They goofed it up. Well, the hindsight confidence is now, well, look at it. If you had invested and stayed invested, here's what would it be. Well, that's hindsight confidence, okay? And that doesn't work, all right? That's chasing. We're not going to chase. So I want us to look forward. You've just given us a couple of good reasons to do so. I want to talk about our good friends that have been fighting with us for a long time now. The bond market. Give us your take, the Horizon's take on the bond market, where it sits right now. What improves the bond market? What helps improve confidence in that area of the market?
Yeah. I mean, that's a very interesting spot, because if we would have had this conversation 3 years ago, nobody would have cared what we had said about the bond market. But now, after what we've experienced the last year and a half, right, it's a talking point. I think what's interesting is that the bond market today is significantly better than where it was a year ago. But that also doesn't mean that it's in a perfect spot either. I think you still got some uncertainty there. And we've had a lot of conversations with advisors. They've had conversations with the end clients. Is now the time to buy back into the bond market? We think we're going to get this, strong rally. At least that's what's been, some folks have asked. And I think our view on that is we're maybe still a little early from tilting back heavily towards bonds. And why I say that is the conversation around the Fed maybe starting to cut interest rates. That's really going to be when you start to get a tailwind for the bond market. And that's probably not, it's probably not a 2023 thing. For that matter, it may not even be until the back half of 2024 when you really start to see some momentum build from an interest rate perspective to help bonds out, to provide that tailwind. Again, bonds aren't necessarily in a terrible spot like they were a year ago, where you're going to see rate hikes cause some headwinds. but you're also not going to get significant capital appreciation. So bond price moves. Now the benefit or the difference year over year is that you should see much higher yields, right? I'm sure you've had plenty of conversations with clients about that. What used to pay 0.5% is now paying 5% in terms of a bond. So that's a much better, I would say, a much better return, a much better set of expectations for a client that's maybe a little bit more conservative. So there is some benefit there. There's a little bit more stability in that yield that didn't used to exist. So there's that benefit. But again, I think as we've talked about, the ability for equities to run and the fact that you probably don't get a lot of capital appreciation in the bond space for the next 6 to 12 months really creates, I would say, this kind of interim tension in the bond market where, yeah, you can go back into bonds maybe and feel a little bit more safe, but don't go into bonds thinking you're going to hit a home run or you're going to get some massive, scream upwards in terms of prices.
All right. And I just want to take that away from investment speak and go to regular conversation. Yeah. By capital appreciation, you mean make money.
Yes.
All right. So
prices, the bond that was worth $100 is not going to be worth $105.
Okay. So capital appreciation, but as you mentioned, you are now looking at a 5% return. So of course the conversation comes to CDs because they're now paying 5%, which is attractive. And just stating the obvious, but I want to state it, based on inflation, you're guaranteed to lose money by buying that 5% CD right now. Okay. So it is a trade-off. A lot of people that'll watch this will remember the 80s. I know you won't, Austin, but I will tell you that coming out of the 70s into the 80s, when you were earning 18% on your CD or 14% on your CD, inflation was 20. So it was the same difference kind of thing. So that all has to be factored in. The stock market has, over a long period of time, been a good place to be, even through the volatility. And that's where we try to manage that together as part of Tranquilli and Horizon Investments relationship. So to wrap it up, and again, thank you for the time. To wrap it up, you've given us an idea of what would propel us forward in a positive manner, what the bond market could look like, some of the good things that can happen. Give us the odds, if you will, not held to them, of seeing a recession in the U.S. in 2023?
Recession in the U.S. in 2023 are probably pretty low odds at this point, Lou. I mean, you're talking 10 to 20% max. And the reason I say that is because if we are to see a recession, a formal recession defined as a recession, however you want to define it, at this point, we're probably so far along and have so many tailwinds at our back that it's going to be tough to get a recession in 2023. Maybe you get one at some point in 2024 if things start to cool off, if the Fed continues to hike interest rates, maybe that causes an early 2024 recession. But to see one in 2023, it's going to be tough at this point, again, because of some of the tailwinds that we've already talked about.
All right. So the theme is cautious optimism.
Yep. I think that's absolutely fair.
I'm going to stick with that. And I think that's a great place to leave it for today. Austin, we'll do this again in the fall.
Perfect. Looking forward to it.
All right. Everyone can't hear you shake your head yes. So yes, we'll do this again in the fall.
Absolutely. Let's do
it. Yes, we will. Excellent. All right. I appreciate it, if not before then. So Austin Fitch, Horizon Investments, always appreciate the time. And like you said, we'll do it again no later than the fall.
There you go. Sounds good. Thanks, Lou. Appreciate it.
All right. Talk to you soon. Thanks again. Thank you, everyone, for taking the time to watch our conversation or listen to our conversation with Horizon Investments. Of course, we have our compliance requirement, and I'm glad to share that with you now. This webinar was created in 2023 and is provided by Horizon Investments, LLC and Tranquilli Financial LLC for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisor reserve the right to modify our current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that our assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have risk assist feature. While risk assist was designed with the goal of limiting drawdown or loss, Horizon is not able to protect and predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all loss. Thank you so much for watching and taking a moment to listen to this compliance read. I will speak with you again next time.